Started. Today we're going to be talking about revenue insurance options for livestock. This presentation has been developed with support from the U.S. Department of Agriculture Risk Management Agency. We received a grant from them to put on a series of crop insurance webinars and do some follow-up with participants. So the Center for Rural Affairs is developing this project in partnership with the Risk Management Agency. I'd like to provide a little bit of background information about our organization. The Center for Rural Affairs stands up for family farmers and ranchers, new business owners, and rural communities. We've been around for more than 45 years, and we've been the leading force in engaging people to build a better rural future. Our mission is to support strong rural communities, social and economic justice, environmental stewardship, and genuine opportunity for all, while engaging people in decisions that affect the quality of their lives and the future of their communities. Just to get some housekeeping out of the way, I'd like to give you some contact information. My name is Cora Fox. I'm a policy associate at the Center for Rural Affairs working on farm policy. My number is listed here. Also joining us today is Anna Johnson, Policy Manager for the Center for Rural Affairs. She leads our farm policy work. Her number is listed. She will be behind the scenes today answering any questions or providing technical assistance for participants. We also have an insurance helpline. This number is specifically used to answer any crop insurance or livestock insurance questions. You can reference that number here on this slide. A few more announcements. The focus of this webinar is on U.S. Department of Agriculture Risk Management Agency insurance products, and will also be specifically focused on feeder cattle. There are other insurance products for other livestock, but to simplify the examples that we'll be providing in this webinar, we've decided to focus on feeder cattle. Additionally, the Center for Rural Affairs has developed some crop insurance webinars that were already presented earlier this week. Those will be posted online, and we can share those with you via email after this webinar. They're focused on crop insurance for beginners and flexible crop insurance options, including the whole farm revenue protection insurance product. For your information, we will be recording this webinar so we can share it as a resource with other producers at a later date. And also, if you have any questions, please feel free to look in your GoToWebinar panel. There is a small hand icon that you can click to raise your hand. During the presentation, participants will be muted, but if we see that you have your hand raised, we'll unmute you to answer your questions. You also have the option, if you need any technical assistance or maybe you have a question you don't want to ask live over the feed, you can ask the question in the question box, or you can use the chat function. At the end of the presentation, we will provide time for participants to ask questions. So a few key takeaways that you can expect to learn from this presentation. What is revenue insurance? What revenue insurance options are available for livestock? How to decide if revenue insurance for livestock is a good fit for your operation, and where to go for more information. This is really a basic, high-level 101 to revenue insurance options for livestock. So I'm going to ask you to take a participant poll, just a few brief questions here. I'm going to open the poll up. I would like to know if either of you are beginning producers, if you've been farming for more than 10 years, or if you're not currently a farmer. Okay, it looks like we need a couple more people to respond to the poll. Okay, so it looks like 43% of you have been farming or ranching for less than 10 years. About 14% of you have been farming or ranching for more than 10 years, and 43% of you are not currently farming or ranching. Thank you. So just to start this off, we're going to talk a little bit about risk in livestock production. I think this is an important discussion to have when thinking about insurance products, thinking about how you can get above your bottom dollar, and looking ahead and developing thoughts regarding what you'd like to say to an insurance agent. So there are a few different types of risk that a producer needs to consider in their livestock operation: production risk, marketing risk, financial risk, institutional risk, and human risk. Production risk looks like the uncertainty in growth of your crops or livestock. This could be affected by weather, disease, pests, and it all affects the quality and the quantity of whatever commodity that you're growing or raising. Marketing risk is the uncertainty regarding the prices that a producer will receive for their commodities, and this includes your input costs. Financial risk looks at your debt to asset ratio and also your access to credit. Then we have human risk, which includes personal crises, death, or accidents. All these things are unavoidable. They come up. You don't know when they're going to happen. Institutional risk. This could include government actions or policies and how they impact a producer. For example, this might look like a tax law or an animal waste disposal regulation. So there are a few different ways to mitigate risk. One thing I'd like to say as well is those examples of risk are not an end-all, be-all list. There are thousands of other ways that risk can impact an operation, but those are just a few things to kick around when you're talking about insurance. So ways that you can mitigate risk. You can develop a strong business plan or a marketing plan. This will help set you up for success. It's really a useful tool when you want to go to a lender and ask for a loan to start your operation. It's also a good tool that you can bring to your insurance agent to kind of provide them some background on the type of operation that you have. One way you can develop a strong business or marketing plan is to talk to an experienced producer. You can also go to your local FSA office or talk to your actual lender, and they can provide you some information on that. Next, you can diversify your operation. This is getting all of your eggs out of one basket, spreading your risk. Many livestock producers also grow row crops, not only for feed, but also to market. So it's important to just consider different ways you can bring income into your operation in case times get tough. Maybe it's that old saying, if grain prices aren't great, you can walk your grain to market by feeding your cattle. That's kind of what some of the old producers used to say. So those are just a few things to consider and trying to set yourself up for success. And lastly, you can mitigate risk by utilizing insurance products. So I have another participant poll. It'll be very brief. I'm going to open it up here for you to take. I'd like to know if you've purchased crop insurance, any product previously. Okay, it's looking like most have voted here. 60% of participants in this group have purchased crop insurance, any product previously. 40% have not. I have a second poll I'd like to ask you at this time that's also very brief. Asking specifically about what insurance product you have utilized, if any. Okay, it's looking like no one has purchased Livestock Gross Margin, Livestock Risk Protection, or Whole Farm Revenue Protection. So this is a good learning opportunity today. Thank you. Moving forward. Okay, so I would like to look at the big picture, livestock insurance use nationwide. And on the Risk Management Agency website, offered through USDA, there's a great tool called a Summary of Business. And I know the writing on here is pretty small, but you can go into this tool. I have the link included. And you can put information regarding different commodities, different insurance products. You can look at individual states, or you can look at a nationwide report. So here I pulled a nationwide report. This is just a screenshot showing livestock gross margin and livestock risk protection, the different policies that were sold. And you can see that livestock risk protection seems to be a little bit more popular. And there's a lot more information that RMA offers, but this is just a nice tool if you want to give yourself a little more perspective and play around on the website. So I've kind of zoomed in a little bit here to highlight the difference here between the policies. Livestock risk protection is a much more popular program than livestock gross margin. So this is the same tool applied to Iowa and Nebraska. I just like to use it to give producers some perspective on how many policies are being purchased. Same situation here. It's broken out by state for feeder cattle, LRP policies. You can see based on the year, it looks like there's a big difference actually between Iowa and Nebraska in policies sold, and there's variation in the policies sold per year. Okay, so now we're going to talk about how you find an insurance agent before we delve into the actual revenue insurance products. I know there's a few beginning producers here on the webinar, and I just think this is a really important part of our discussion. So on the USDA Risk Management website, there's actually an agent locator tool. I've included the link on this slide. In this tool, you can go in, you can put your actual physical address in, you can click on a city, you can select a specialty, crop, livestock, or both. You can look at different languages, maybe if you're bilingual, maybe if you'd like your information to be in Spanish, you can click on that to find someone that speaks Spanish. You can select a distance from where you're at, so maybe you want someone within 10 miles of you, or maybe you're fine driving a distance to an insurance agent. You can select all of those, and you can go to the state that they're licensed in and the county that they're licensed in as well. This is just a nice tool if you are not familiar with the insurance agents in your area. When you click all of these options, it'll pull up a map for you. I apologize, this is really small. These are screen grabs, but you can see from the map that it's pinpointed different locations based off of the information that I've put in. And it gives you the actual addresses, the names, and the phone contact information, phone numbers for the insurance agents in your area. So I just think this is a helpful tool in looking at all the different options around you and folks that you can talk to. Something to note, this agent locator picks up agents that are approved by the risk management agency. So that should give you some peace of mind with the folks that you'll be speaking to. So here are a few questions that I like to kind of list out before you decide to have a discussion with an insurance agent. Again, this is not a comprehensive list, but these are a few things that might help you get started. It's important to think about how big the premium will be and how much the producer yourself will be responsible for. There is a cost estimator tool on the risk management agency website, and this helps you estimate how much your premium might be. So I've included that link here as well. Something else to talk with your insurance agent about would be important deadlines. So when you need to make your payments for your policy, some different reporting requirements. These are all really important in just understanding the actual product that you are going to be utilizing. Lastly, I think it's important to understand how long it takes to process a claim and receive an indemnity if it's been determined by RMA that you need an indemnity payment. Each insurance product is a little bit different, so these are all specific details that you should ask your insurance agent about in person. Okay, so now we're going to delve into some types of livestock insurance that the risk management agency offers. Again, we're focusing on revenue insurance, so these products are not going to cover death or loss of any animals. So first up, we're going to start with livestock gross margin. I've included a link to the Livestock Gross Margin Frequently Asked Questions document. This is also a helpful tool for producers to reference when they're considering different policies. Okay, so now we're going to get into overview and purpose. Livestock gross margin uses futures prices to determine the expected gross margin and actual gross margin. It provides protection against the loss of gross margin, which is essentially your market value of livestock minus feeder cattle and feed costs on your cattle. Livestock gross margin is not based on your local market. The prices for livestock gross margin for cattle are based on simple averages of futures contract daily settlement prices. It does not cover sickness or death in livestock. Eligibility for this insurance product. It's available to producers who own cattle in the following states: Colorado, Illinois, Indiana, Iowa, Kansas, Michigan, Minnesota, Missouri, Montana, Nebraska, Nevada, North Dakota, Ohio, Oklahoma, South Dakota, Texas, Utah, West Virginia, Wisconsin, and Wyoming. So it's really important to know that this is not a nationwide program. The cattle must be sold for commercial or private slaughter for human consumption, and they have to be fed in those above states. So purchasing livestock gross margin. Coverage can be purchased on the last Friday that is a business day of each month. Coverage for cattle begins one full calendar month after the sales closing date. So I've given an example. If your sales closing date is January 31st, your coverage begins on March 1st. The contract change date is April 30th, and the contract cancellation date is June 30th for all insurance periods. If you have questions about any of these dates, I highly recommend speaking with an insurance agent. For livestock gross margin, there are 12 insurance periods each year. Each insurance period lasts 11 months. So just like we mentioned above, no cattle are insured in the first month. How livestock gross margin works. A producer can insure all their cattle expected to market over an 11-month period. If the insurance product is purchased January 31st, the insurance coverage expires December 31st, 11 months later. To receive an indemnity at the end of an 11-month period, there must be a positive difference between the gross margin guarantee and the actual gross margin. A few slides from now, we're going to go through and kind of describe what these words mean and how they work. Something that's really great about livestock gross margin is that the producer doesn't have to decide on the mix of options to purchase, the strike price of the options, or the date of entry. So how is the expected total gross margin calculated for each insurance period? The expected total gross margin is the sum of the target marketings times the expected gross margin per head of cattle for each month of the insurance period. So for example, if you're a producer that has 10 head of cattle and the expected gross margin per head is $125, the expected total gross margin would be $1,250. How is the gross margin guarantee calculated for each insurance period? The gross margin guarantee is calculated by taking the expected total gross margin minus the total number of cattle to be marketed times the per head deductible. So an example here would be if you have 10 head of cattle to be marketed and your expected total gross margin is $1,250 and your deductible is at $50. You would take 10 head of cattle times your deductible and subtract that from your expected total gross margin. The gross margin guarantee for this example would be $750. So what's the actual cost of feed? There are two different options here that producers can choose. There's a yearling finishing and there's calf finishing. So for yearling finishing operations, the actual cost of feed for each month equals 50 bushels times the actual corn price for that month. And the actual corn price comes from the Chicago Mercantile Exchange. The calf finishing operations, For calf finishing operations, the actual, excuse me, I'm having technical difficulties here. I apologize for that. My slides just kind of went off my screen. They should be back on. If they're not, please raise your hand and let us know. So back to where we were, calf finishing operations. The actual feed cost for each month equals 52 bushels times the actual corn price for that month. So for the actual cattle price, actual cattle prices vary based off of the month throughout the year. For the months February, April, June, August, October, and December, the actual cattle price is the simple average of the daily settlement prices in the last 3 trading days prior to the contract expiration date. For the months January, March, May, July, September, and November, the actual cattle price is the simple average of the daily settlement prices in the last 3 trading days prior to the contracts that expire in the immediately surrounding months. So this is something that you need to sit down and talk with your insurance agent to discuss. How is the actual total gross margin calculated? Your total gross margin is calculated by taking your target marketings times the actual gross margin per head of cattle for each month of the insurance period. So for example, your target marketing, you might plan to market 10 head of cattle, and your actual gross margin per head of cattle is $50. So you would take your 10 head of cattle times your $50, and that would give you $500 for your actual total gross margin. Okay. So like we talked about earlier, there are 2 different options to choose from, finishing yearlings or finishing calves. This is kind of complicated to understand, but the expected gross margin per head of cattle in a month for a particular state for yearling finishing operation is the expected cattle price for the state and for the month the cattle are marketed. So this is state specific and month specific, times the assumed weight of the cattle at marketing. So maybe you're doing, maybe it's at 12.5, so 1,250 pounds, minus the expected feeder cattle price for the state 5 months prior to the month the cattle are marketed, times the assumed weight of the feeder animal, so in this case, it would be 750 pounds, minus the expected cost of feed 2 months prior to the month the cattle are marketed. I know that's very confusing, but I at least wanted to put it up here on a slide. You can get more detail from the Risk Management Agency website, or if you speak to an insurance agent, they can provide this information to you as well. For finishing calves, the expected gross margin per head of cattle in a month for a particular state, and for the specific month of the cattle are marketed times the assumed weight of the cattle at marketing, so maybe they're at 1,150 pounds, minus the expected feeder cattle price for the state 8 months prior to the month the cattle are marketed, times the assumed weight of the feeder animal, say 550 pounds, minus the expected cost of feed 4 months prior to the month the cattle are marketed. So again, they seem pretty complicated, but your insurance agent should be able to provide this information to you. So how are indemnities determined for livestock gross margin? Indemnities will equal the difference between the gross margin guarantee and the actual total gross margin for the insurance period. So from the example we were discussing earlier, if your gross margin guarantee is $750 and your actual total gross margin is $500, if you subtract the 2, this will leave you with an indemnity of $250. If you have any additional questions regarding livestock gross margin, feel free to check out the Risk Management Agency website, or again, talk to your insurance agent. Next up, we're going to talk a little bit about the Livestock Risk Protection insurance product, which is offered through the Risk Management Agency. I've included a link to the Livestock Risk Protection fact sheet. Feel free to reference that for more detail. So first things first, what does Livestock Risk Protection do? Livestock Risk Protection protects against declining livestock prices if the price drops below the producer's selected coverage price level. Livestock Risk Protection does not cover sickness or death of your livestock. This is a revenue insurance product. Eligibility for Livestock Risk Protection. Livestock Risk Protection is available to producers with feeder cattle in the following states. Much more comprehensive than LGM state-wise. Alabama, Arizona, Arkansas, California, Colorado, Florida, Georgia, Hawaii, Idaho, Illinois, Indiana, Iowa, Kansas, Kentucky, Louisiana, Michigan, Minnesota, Mississippi, Missouri, Montana, Nebraska, Nevada, New Mexico, North Dakota, North Carolina, Ohio, Oklahoma, Oregon, South Carolina, South Dakota, Tennessee, Texas, Utah, Virginia, Washington, West Virginia, Wisconsin, and Wyoming. Purchasing Livestock Risk Protection. Livestock Risk Protection insurance is available throughout the year for purchase. Talk to your insurance agent to get more information about when those dates would be. Livestock Risk Protection coverage. Coverage is determined by the number of livestock that you'll be marketing times the market weight times the coverage price level. There are some different coverage level options between 70 and 100% of the expected ending value. The length of insurance coverage available for each specific coverage endorsement is 13, 17, 21, 26, 30, 34, 39, 43, 47, or 52 weeks. So once a producer goes into their insurance agent's office, signs up, submits an application for livestock risk protection, then they have the option to choose the different specific coverage endorsements, so any of those week options. Coverage prices, rates, and actual ending values are posted on RMA's website. So livestock risk protection is really great for small herds. I mean, it's great for a lot of different livestock operations, but it's particularly useful for small herds because there's no minimum of the number of livestock that you have to use for livestock risk protection. Additionally, something to note is that livestock risk protection is federally subsidized. So depending on the market and the time of year, it's possible that this insurance product could be less expensive than other programs that use the futures or options based off of the Chicago Mercantile Exchange. So LGM uses more of the futures and options, so it just depends on the market and the time of year. It's possible that livestock risk protection could be a little more affordable. So how livestock risk protection works. There's coverage available for feeder cattle that are calves, steers, heifers, predominantly Brahman cattle, or predominantly dairy cattle. There are two different weight ranges of cattle that can be covered under livestock risk protection. So those under 600 pounds and those between 600 and 900 pounds. Something else to note is that there's an annual limit for feeder cattle, 2,000 head per producer per year, and the year for this insurance product is from July 1st to June 30th. So there's a way you can estimate your costs if you want to kind of develop the idea before you go in and talk to an insurance agent. You can utilize the Risk Management Agency Cost Estimator tool. I provided a link here on the slide. The tool asks you to select and provide information in a few different fields. So for commodity, you might put feeder cattle, and just for an example's sake, I put commodity year for 2018. You can select your state, your county, the type of commodity. So in this case, it would be steers. You can put your target weight. The endorsement length would be the period that you've chosen, the specific endorsement period, the number of head that you have, and then maybe the coverage level. So if you do all of that, you'll see this is a screen grab. It will pull up more information regarding the details that you provided, and it will look at it'll provide information on your liability amount, your total premium amount, which is what you see here, and it'll also go into like what the producer's premium amount, so what you would pay. So this is just kind of nice, playing around with some figures. You can look at different coverage levels. You can kind of see what might work best for your specific livestock operation. Again, this is all on the Risk Management Agency's website for reference. So let's talk about livestock risk protection indemnities. At the end of your insurance period, if your actual ending value is less than the coverage price that you've chosen, the producer will be paid an indemnity for the difference between the coverage price and the actual ending value. So just to give an example, you'll have your insured value, which is your head of cattle, times your coverage price, times the weight. Then you'll have your final price at the end of your coverage period. So that could be, at the end of 13 weeks, 21 weeks, whatever you've chosen as a producer. Then you'll have your actual revenue, which is your head of cattle times your final price times the weight of your cattle. And then you can find your indemnity by taking that insured value and subtracting the actual revenue from it. That will give you your indemnity amount. So this is very basic for example's sake, but again, if you have additional questions, I encourage you to speak with your insurance agent. Okay, so moving forward, I'm going to briefly touch on an insurance product called Whole Farm Revenue Protection. I'm not going to spend a whole lot of time on it because we actually developed a presentation, a webinar earlier that was presented earlier this week, and it will be posted on our website, and that information will be shared with you post participation in this webinar. So just to give a little overview, Whole Farm Revenue Protection is a relatively new insurance product. I believe it was created in 2014. It protects against the loss of insured revenue due to an unavoidable natural cause of loss occurring in the insurance period and carryover loss coverage if insured the following year. It provides a risk management option for all commodities on one farm under one insurance product. So this is an insurance product that's really great for highly diversified operations. Maybe you have crops that don't have insurance products available in your county, or maybe you're an operation, like for the purposes of this discussion, that has, maybe you grow some vegetables and some row crops and you have livestock and you want to make sure you get everything insured. So this is one insurance product for your entire operation. It's available in all counties nationwide. So even though it's a relatively new product and some folks haven't heard of it, it is available. So if you go into your insurance agent's office, they should be able to provide you information on Whole Farm Revenue Protection. The product covers up to $8.5 million in insured revenue, but for livestock, it only covers up to $1 million. So that's just an important thing to note. Again, if you are looking for an insurance agent, feel free to utilize the Risk Management Agency Agent Locator tool to find one close to you. If you'd like more information, again, this webinar will be posted on our website. I've also included a link to a fact sheet from the USDA-RMA website. Okay. So now I would like to open it up for any questions that attendees might have. I'll do my best to answer your questions, and if we come across any that need some more follow-up, we will get in touch with you after the presentation. So now we're going to open up, we're going to unmute everybody. Does anybody have any questions on livestock gross margin, livestock risk protection, or whole farm revenue protection? If you're uncomfortable speaking over the mic, feel free to type a question in the question box or chat us. I'll give it a few more minutes. If you have any questions, feel free. You can also select the small hand icon to let us know that you have a question.
There's a question that's come in that says, how many organic farmers have bought this? And from Kathy Zeman. Kathy, are you referring to, would you mind clarifying which one of the insurance products you're referring to?
That USDA site. Maybe it's available on that USDA site, but I guess if any of these programs, I wonder how many organic farmers have taken advantage.
Thank you for your question, Kathy. Unfortunately, I don't have information specifically on organic farmers. After this webinar, though, I can take some time to look into that some more and provide some follow-up for you.
Oh, thank you very much. Thanks.
You're welcome. Does anybody else have any questions? Let us know. You can click the question mark or the hand. Okay, so it's looking like we're not having many questions coming in. That's fine. I know that this is discussing insurance products can be pretty complicated, and like I discussed at the beginning of the presentation, this is a pretty high-level overview. But I hope if you have additional questions that you'll reach out to either Anna or myself utilizing the contact information provided at the beginning of the presentation, or you can call our crop insurance hotline. Or if you'd like more specific detail based off of your unique livestock operation, I highly recommend using the RMA agent locator tool, finding an insurance agent close to you, and setting up an appointment to discuss these different revenue insurance livestock options. Thank you so much for taking time to join us today. And like I said, if you have any additional questions, feel free to reach out to us. Have a good day.